this business, my work is based on the trust that my customers give me, and I can't lose this trust. If they ask me to customize something to make it this way or that way, I definitely have to deliver and make it happen.
Well, trust is the foundation of our business. We're not talking about a few thousands of pesos given to us for safekeeping. We're talking about hardworking folks like yourself entrusting with us billions of pesos to manage for them in a good and responsible way.
The challenge is to keep this trust, even though there are so many things that are beyond my control.
Because we need to make our clients' money grow. Like you, we do our research. We look at many factors: the economy, politics, what's going on abroad. All of these things affect business. But we don't want our clients to be left behind. We want to bring you to the forefront of new ideas. We want to bring you to industries that you may have never even thought of investing before. We want to do this for you and bring you to worlds of investing that you may know nothing about.
What is important to you is important to us too. Your values are our values. Clients know that we mean what we say. They have now entrusted ATRAM, a multi-awarded asset management company, with their investments. Each day, we wake up with fresh ambitions, wanting to do what matters to us, for people who matter to us. We do what we have to do. We live for today and work for the future. We are ATRAM. Your future, our present.
Hello and good morning, everyone. Thank you for joining this week's episode of ATRAM's webinar series. Today, we'll be touching up on global fixed income as we give insight on the market as well as identify opportunities that come along with it. I am Paolo Idilior, Business Development Manager at ATRAM. We want today's episode to be as engaging and interactive as possible. So stay tuned as we will have a live Q&A at the end of the presentation. You can also submit questions throughout the discussion by clicking on the Q&A button found on your screens. Additionally, I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day as well as posted on all our social media pages. Make sure to stay until the end as we will be wrapping up with a quick feedback form. This morning's session will revolve around getting to know more about our portfolio manager. As one of the top fund management institutions, we want to provide you with this kind of access as we believe that being open and transparent would add value to you. Once again, we are lucky to be joined by one of our fixed income portfolio managers. If not trading or doing research, I usually catch them crunching numbers and doing simulations in order to constantly improve their portfolios. Lodevico Ulpo is a chartered financial analyst, charter holder, certified financial risk manager, and he is also a certified public accountant. He spent some time working in private banking and hedge fund companies in Hong Kong. Now back in Manila, ladies and gentlemen, I'd like to introduce Mr. Devi Ulpo.
Good morning, everyone, and I hope that all of you are well and safe in your homes. Hope this webinar finds you well.
Thanks, Dev. For the benefit of our audience and to provide a bit of context given ATRAM's global reach, we have audiences from North America, Europe, the Middle East, and across Asia. Can you briefly speak about your time in Hong Kong, as I believe you were still there when the protests ensued? Incidentally, this will be related to your topic, which is the global fixed income space.
Right, so most of my experiences has been on trading and investing in global fixed income. My exposure on this space is mostly on global rates, global credit, and credit derivatives. So I worked for quite some time in Hong Kong in an Asian hedge fund, so trading investment grade and high yield bonds, and also with a global macro-oriented multifamily office, trading global rates in Europe and in the US. So that is when before I returned to my home firm and where I started ATRAM. So today, I will be updating you on the developments within the global fixed income space and the opportunities that the asset class represent, the value of active management to have an optimal risk-adjusted returns in your portfolio. Next slide, please. All right, so just a quick recap. So the coronavirus pandemic has triggered a global policy response like no other, both in scope and in magnitude. Most countries have provisioned for better healthcare services and extended unprecedented support to households, firms, and financial markets. Policy makers ranging from the World Health Organizations, global central banks, governments have ensured to prioritize survival of citizens' lives, livelihood, and businesses throughout ordinary accommodative measures. So suffice to say that the great lockdown we experienced and the massive stimulus given by the global policymakers, despite enormous short-term economic costs and unwanted losses, such as debts, fortunately, still have saved hundreds of thousands of lives and jobs. Next slide, please. So the economic releases have shown that hard data have started to beat weak market and economic expectations, implying that worst case scenarios have been considered, digested, and well imputed into investors' assumption in traversing into this fragile yet hopeful market and economic recovery in the medium term. So while most countries chose to address reopening with a cautious stance, as new cases and deaths continue to pile in, increased testing and better healthcare capabilities have provided comfort to citizens to carry out usual spending patterns, causing resumption of consumer demand. On the supply side, liquidity lifelines and regulatory relief to businesses have shown that governments have been sufficiently proactive with its initiatives to provide economic safety net. Overall, while current conditions remain weak on an absolute basis, the outlook seems promising and improving gradually, causing majority of investors to revisit and entertain a higher likelihood of a V-shaped recovery. So on this slide, you will see that risk assets such as global equities and global credit have shown momentum in the last 6 to 8 weeks as risk appetite returned, causing risk premiums to decline while borrowing costs and overall market volatility remain low. So for now, I think that for policymakers globally, to be sure that recovery is sustained, accommodative policies will remain in place as the economy gradually reopen to help ensure continuity of the economic safety net worked for hard by our global policymakers. Next slide. So, however, I think let us take a step back as we digest this information. So today, investors and everyone else are likely facing similar questions as we navigate in this environment. So there are 3 important ifs to monitor in the short term to medium term as we embark on surviving in this cautiously optimistic world. Okay, the first if is whether economies and businesses will adapt in this new normal. So while we are hopeful, the answers remain unclear, but the scenarios are not. So we can map out those scenarios. So if we are successful, we may resume growth as a country. The good ones in the business community will likely gain market share and improve their overall operational efficiency. However, the flip side is rather fearful. Recession, unemployment, and bankruptcies could have longer lasting effect to the quality of living. So again, uncertain. The second if is whether there will be no second wave of infections as economies reopen. So this remains to be seen. So right now, who knows? And our survival will likely depend on the personal discipline in carrying out social distancing as individuals, families, and as a community. The effect of this if is very tremendous as it affects us physically, psychologically, and mentally. Fears of like death, panic on the negative side, and on the positive side, recoveries, hope, and general calm. Again, uncertain. The last if, and I think this is the most important one for everyone, is whether there will be a vaccine available for all of us. This will determine whether we will be reuniting with our friends and family as we try to sustain this economic and business rebound, or unfortunately, on the negative side, this would likely cause prolonged social distancing and may result to permanent business disruptions, which can all the way go and cause another rounds of unemployment and another recession for the economy. That's, I think, still reiterating the fact that at this moment, uncertain.
I believe you are on point by saying that there are so many what ifs in the world right now, and you impeccably mapped it out. What gives value at being an active manager in this type of environment?
All right, so I'll go to the next slide to expound more on that. Okay, so given the three ifs, the uncertainties we face, we would like to be positioned dynamically as we navigate in this cautiously optimistic environment. As information evolves and as we get more answers to the questions cited before the slide. So in this slide, you will see on the right-hand side the categories credit rating agencies use to classify and disaggregate fixed income investments according to the credit risk or the measure of likelihood of being safe on the cash flow side and on the principal side issued by bond issuers. So right now, so AAA bonds bear the highest quality, BBB bonds provide adequate risk, bonds that are double Bs or lower are considered junk and are quite risky in this environment. So to maximize total return, but at the same time protecting our portfolios, we want to be distinguished first the environment. So what we are facing in terms of scenarios and be able to use that appropriate instruments available to capitalize on existing opportunities. In this case, we rotate the credit quality and invest in instruments that will perform cognizant of the risks we face in the short to medium term. So in fearful times, we want to be invested in high quality names such as AAAs, AAs, as these bonds tend to outperform in high risk volatility times. Meanwhile, on the flip side, in hopeful times such as growth, triple Bs outperform AAA bonds as they are the beneficiary of the positive cyclicality of macro environment. As we do this, we maximize the total return of the portfolios achieved by maximizing the capital gains on top of the yield you receive from holding these bonds. Hence, we can say that investing in an actively managed global fixed income fund provide us the opportunity to capitalize on dynamic and constantly evolving global markets. Next slide. So what we discussed in the previous slide is more an overall framework to make money in this changing time. So let us go and look at the current investment environment. So today, we think As a recap, we think that medium-term investment-grade bonds will outperform safe havens and junk bonds, as this asset class provides investors the safety of bonds and the potential capital gains from assuming reasonable risk. Currently, interest rates have remained low and stable. So overnight, the Fed has pledged to keep policy rate near zero for the next 2 years to keep the economy's safety net intact. However, I think given the optimism of the market, additional policy on top of that may not be on the table. It will just be kept there. So that can cause long-term rates to rise, given that the US will borrow more on the long end, as better economic conditions is seen on the rebound. So given this, we expect the 2 to 10-year part of the dollar interest rate curve to be the place to be. And to tie that up with what I've discussed earlier, going to the triple B space on the 2 to 10-year part of the curve may be a good idea, as yield premium from holding riskier bonds are on a decline. So going credit spread tightening causes capital gains. That translates to a better total return for your portfolio. However, as optimistic as we may want to be in the short to medium term, we still need to pick our spots. Keep the risk moderate, and given our investment process, which I will show you later, deep junk bonds and distressed bonds are not the sectors where you want to be invested in the still uncertain environment. We may see inevitable bankruptcies, restructuring, rating downgrades, and those three scenarios may actually cause massive amount of capital losses for the investors invested on those deep credit rating sector. Next slide. Okay, so here in ATRAM, we manage our fixed income portfolio actively with a total return approach, combining our understanding of macro environment, asset allocation, rotation, credit fundamentals, and bond structures to actually enable us to pick the right spots in the right environment. So here, our investor universe allow us to diversify globally with particular focus to emerging Asia and Middle East. This is where we see the sustainable growth and the quicker rebound, so to say, compared to developed markets. So our thesis over the last 2 months have since played out, being invested in US Treasuries, Emirates of Abu Dhabi, State of Qatar, Saudi Arabia, South Korea, China, Malaysia, as well as positioning on some triple B bonds such as the Philippines and Indonesia. So as you see on the right-hand chart, we look and we approach our portfolio management as on a top-down basis in picking the right spot in the global fixed income landscape, while we use the bottom-up approach in picking the right issuers, such as corporates and specific government quasi-sovereigns, to ensure the quality of the credit we pick is appropriate to the portfolio. At the moment, given our outlook on rates and credit, we have shifted towards some medium-term duration on our dollar portfolio, while gradually growing down the credit risk curve as the environment gradually improves. So in the short to medium term, this may mean increasing allocation on corporates, but we would like to pick very high quality corporates to ensure that the credit risk is appropriate, while sovereign bonds, high grade and investment grade sovereign bonds will remain our core positioning in the short to medium term. So I think in ATRAM, we think that this is the most dynamic and prudent approach in investing in the space, focusing on liquid bonds to ensure the effectivity of the strategy.
That's a great outlook, Dev. Now, lifting off from ATRAM's famous three-point rule, what three things would you like our audience to get a hold of?
Right. So next slide. So as a recap, so let's make it a little bit simple now. So the global fixed income space provides you with a dynamic risk profile through active management. So having the opportunities to assume moderate risk, being able to invest in safe havens, and assume reasonable credit risk at the right time, given the right information. The second point is that, again, let's take a step back and monitor the three ifs to help us navigate our investment portfolios and ultimately our lives. Given that, point number three, the global economy, markets, healthcare, and policies evolve rapidly in these uncertain times. Thank you very much, and I'm happy to take your questions.
Thanks again, Dev. At this point, shall we look at the questions from the viewers? I have a question here. Do you ever hold the bond to maturity?
Okay, so interesting question. So the way we approach it is we try to bucket our investment approach towards holding safer bonds for hold to maturity to increase the yield. So for example, we might buy a corporate 2-year to kick the yield of the portfolio higher, but hold on to it in the short to medium term. However, for longer duration bonds, we try to trade it, meaning we position dynamically to be able to rotate, going into riskier towards safe haven. Because I think in this environment, the best way to capitalize on those opportunities is being dynamic. Because right now, it's uncertain. The information we get is live. Once we get more certainty, we can shift the portfolio on the right-hand side, which is the riskier side, or if, again, we experience some kind of volatility like back in March, we can dial down the risk of the portfolio and go to the safer havens. However, I think on a broader case, 60 to 70% of our portfolio is mainly to rotate on changing environment, and then 30% is kind of like the bonds we consider core holdings that we may hold towards maturity to ensure that there is still yield stability that we give to our investors in the fund.
I see. So in your presentation, you talked about investment in USD bonds outside of the Philippines and the US. I don't think there are many funds that locally that do that, at least. Are there better opportunities out there, and is it safe?
Right. So at the moment, I think you have to look at in investing in global fixed income, we have to look at Philippines as another investment vehicle for the global funds. So I think if you are holding mostly Philippine dollar bonds, you will face the risk similar with a global investor would face, meaning you are holding triple B bonds, which in the whole context of everything, it is still not in the safer side of things, which means that if you're holding that to maturity, once you see volatility, your portfolio will be volatile. However, if you look outside, there are relative value opportunities such as single A's, double A bonds, which actually can make your portfolio safer relative to comparing it to a pure Philippine bond perspective. So I think that's the value of looking outside. You can make your portfolio safer, so to speak, in times of volatility. But at the same time, you can explore better trading or total return opportunities out there, such as, for example, Malaysian bonds, Indonesian bonds. You can buy those bonds, similar risk profile as the Philippines, but you get better yield. So those are the types of investment opportunities that we face if we look outside the Philippines, and I think the broader set of investment universe is available for us to deploy on.
I see. Thanks. How about corporate bonds? What's your view? Which one do we like?
Right. So for corporate bonds, we tend to like the safer ones, meaning those corporates that have a very strong balance sheet. We can talk about more on the Philippines. So for example, we would like to have corporate bonds that are stronger in terms of like brand equity, better credit risk profile, that have better payment considerations. So for example, here in the Philippines, we would like to be positioned for the conglomerate names, the household names, the SMs, the Aboitises, the Ayala Corps. I think in the whole context of everything in that investment universe, these bonds provide you a little bit of stability on the yield side, unlike going outside in terms of buying corporate bonds in other countries. Our Philippine corporates are actually more stable in terms of price volatility, but it also gives you a little bit of yield pickup. So in picking our spots, we consider the liquidity, the volatility of the bonds that we invest in. Philippine corporates definitely have a place to invest in. I think we have to still approach it from a bottom-up perspective, know the risks, know the scenarios that we may face moving forward. So I think investing in corporate bonds, we just have to map out the scenarios, do our usual stress testing in credit analysis, and pick the corporates that will perform and that will be more stable in these very uncertain times.
Okay, I have a quite specific question here. What happens to the coupon interest in a fixed income bond fund as opposed to the coupon interest earned by directly owning a bond instrument?
All right. So given that, so if you choose to buy a single investment, naturally you would assume that the coupons, the cash flow will be coming up on a regular basis. But I think you have to look at it as well from the risk that you took. Again, if you're receiving regular coupons, that is not the same as to the risk profile you assume at any given point in time because the environment will change, right? That opposed to a global fund where the coupon might or the yield might actually change over time, but the idea is it adopts in different market environments. So you don't want to be holding the same bond that you hold 2 years ago, and right now these corporates might actually go under or may actually face tougher times. So I think in this crisis or recession scenario, you have to be able to understand the risks that you face by holding single investments. And I think in a fund, you have a diversified pool of investments, which makes your principal actually safer in terms of credit risk profile because you have lower idiosyncratic risks you face. Second is that a fund can change its characteristics. The risk might change and it will adapt to the environment rather than holding a single bond and hope that cash flows will come in regularly. I think you have to be careful on that, right? So you have to be managing your money better than that, meaning hope is not something that makes you money longer term. I think
Right.
due diligence does, right?
Right.
Especially in these uncertain times where
Yes,
corporates,
Deb.
lower rated corporates might face cash flow problems.
Thank you, Deb. You mentioned that there are still 3 ifs, but based on what you are seeing, and this is the last question, should investors
Right.
still be investing in global bonds right now? What are the prospects currently?
Right. So I think given the 3 Fs and the scenarios we're facing, it is still uncertain. So I think we buy a global fixed income fund to get the moderate risk profile and to be able to take advantage of opportunities on the safer side and on the riskier side of things because of the active management. I think the upside is still tremendous given the investment universe that we face as a global fund manager.
Okay, thank you, Deb. I think we can leave it there for this webinar. Thank you once again to our audience as well for your questions. If you have any further questions or would like to learn more about ATRAM's funds and strategies, please get in touch with your relevant ATRAM relationship manager or visit our new website, www.atram.com.ph. Lastly, please answer the survey at the end of the session, as your feedback is valuable to us. We appreciate you taking the time to join us. On behalf of ATRAM, I would like to wish for the safety of you and your family. Best of luck. Thank you very much and have a great long weekend ahead.
Great, perfect. Thank you.